Welcome to Richard Suttmeyer's 4 in 4. 4 blips on my radar screen, presented in 4 minutes or less. My first blip continues to track the yield on the 5-year US Treasury and the Fannie Mae spread. The 5-year should continue to track between 3.75 and 3%, with this week's support at 3.598. After the dress rehearsal of the Ben and Hank show Friday afternoon, this spread narrowed to 77 basis points from around 99. After the debut in Congress on Tuesday, the spread widened back to 85 basis points. I track this spread as it signals confidence in Fannie and Freddie. Ending Wednesday at 92 is a clear vote of no confidence for the Ben and Hank show. My second blip discusses Bernanke Double-Talk on the outlook for Fannie and Freddie. In the question and answer session following a second day of semi-annual testimony, this time before the House Finance Committee, the Fed chief said that nationalization of Fannie and Freddie may be an option. Then he said that Fannie and Freddie are in no danger of failing. If that's the case, why do we need the Ben and Hank show? The Fed chief said that he's thinking about the needs of the housing market, but is he really? The housing market needs cheap funds to finance and refinance mortgages to stop defaults and foreclosure. The Ben and Hank show does not address this. Bernanke said, as Fannie and Freddie share prices fall, it's more difficult for them to raise cash. And that if their debt spreads widen, it increases their borrowing costs. Guess what? Both Fannie and Freddie trade below $10 because investors want out. Since the dress rehearsal of the Ben and Hank show, which was last Friday, the 5-year Fannie spread has widened from 77 to 92. Meanwhile, time is wasting as defaults and foreclosures rise with no rate relief on the way. Bernanke then passed a buck to the Office of Federal Housing Enterprise Oversight, which regulates Fannie Mae and Freddie Mac. They told him Fannie and Freddie are fine and can continue to operate, and there's nothing about to happen. My third blip justifies my view that the July National Association of Home Builders Housing Market Index hit a record low of 16. The NAHB chief economist David Siders said, given the systemic deterioration of job markets, rising energy costs, and sinking home values, aggravated by the rising tide of foreclosures, many prospective buyers have simply returned to the sidelines until conditions improve. The minutes from the June 24-25 FOMC meeting mirror these concerns. The information reviewed at the June meeting indicated that economic activity remains soft in recent months. Residential construction continued its steep descent, which is why I've been worried about the $625 billion in construction and development loans on the books of community and regional banks. My fourth blip shows that the Dow Industrial Average is ripe for an oversold rally. Tuesday's low of 10,827 was within 80 points of my annual support at 10,747, and it now appears that the Dow will stay below its 120-month simple moving average at 10,563 at least this month. Resistance is the 200-week simple moving average at 11,690. If you have any comments or questions, shoot me an email, gmcreports@aol.com. That's today's 4 in 4. Enjoy your day.